Vietnam is growing fast. It's been called an economic miracle of the 21st century. In 1989, Vietnam's GDP was ranked 75th in the world. Over the last few decades, however, growth has looked like this. But the question is, what is driving growth? Here are 3 factors putting Vietnam's economy on the fast track. Number 1, vaccination rates. To start off, the Click spoke with Nick Bartlett, Director of CBIP Logistics.
I certainly wouldn't disagree that it's probably accelerated their bounce back from COVID. If you look at third world countries, which I think Vietnam still probably sits in there somewhere, maybe coming out the other side of it a little bit, but as an emerging market at least, certainly very, very good response. In terms of whether or not I think it's having an impact on their growth, I think the Vietnamese are kind of in one gear, and that gear is fast forward. I think for them, because they're in that one gear of fast forward, it was just about getting through and getting back to work. And I think that's a direct explanation for why the response rate to COVID was so strong. We have a number of clients that are manufacturers that are based in Vietnam, and their whole livelihood is backed on this, right? So no work, no money. And when you still live in an economy where money is, month to month, getting back to work is the only option. And that's exactly why you saw such a strong response. And that coupled with a really strong kind of new labour market, in my opinion, certainly has been great for Vietnam.
Researchers at Johns Hopkins show that nearly 90% of Vietnam has received at least one dose, which is good considering the global average is 70%. So with a healthy population, the economy can bounce back fast, which means more businesses opening up and more money coming in. This brings us to number 2, foreign direct investment. According to the Foreign Investment Agency, Vietnam is likely to bring up to $38 billion in 2023. Among nations pouring money into Vietnam, Singapore ranks first. And Singapore is in the top 5 for FDI globally and number 1 within Southeast Asia. So lots of money is going to Singapore, which ultimately means lots of money is going to Vietnam. Next, we'll hear from journalist Michael Tatarski.
I personally think that's the biggest factor. I think that, again, especially in this first quarter, the domestic economy is pretty anemic. State-owned enterprises are famously wildly inefficient. And then, the exports that FDI is driving. Vietnam's trade as a percentage of GDP is off the charts. That is so they've been a huge beneficiary of this shift from China. But to me, that is the number one reason.
Next, we'll hear from Brooke Taylor, CEO of Vina Capital and co-author of the upcoming book, Vietnam, Asia's Rising Star.
It is certainly a growth driver, but it's actually not the beginning of the story. What's going on in Vietnam is called the East Asia Development Model, and it's an economic theory that's pretty well proven. And if you think about the rise of post-war Japan, post-war South Korea, post-war Taiwan, and even the eastern seaboard of China, they have followed a very, very similar route to economic growth and prosperity and have essentially become high-income nations. And what that involves is basically starting with the only resource that you have, which is people. And you start manufacturing very, very low-cost items like garments and footwear and assembly type stuff. And then what happens is that generates foreign exchange, of course. So you buy higher quality materials and you move up the value chain.
This now brings us to number 3, inexpensive labor. Data from the National Wages and Productivity Commission stated Vietnam's average monthly wage is around 1/3 lower than wages in other Southeast Asian countries and nearly half the cost of China. For foreign investors, lower labor costs creates a significant business advantage compared to other countries.
But when you think about that idea around labor cost, what happens in Vietnam is that if it becomes too expensive for a labor cost in one city or town, then the factory will move to the next town, city, or province, right? It means that what normally happens is the labor force will move with you. But even if they don't move with you, it's not such a big thing. There's plenty of people around, and you can move easily to the next province. What that means is the country develops very evenly.
So, thanks to vaccinations, FDI, and labor costs, Vietnam's economy is on the fast track. But going forward, what does Vietnam need to do to stay on track?
In my opinion, it's probably, making sure they keep their doors open, making sure they diversify on their production lines, making sure that they keep investing in infrastructure. And I think if they keep doing those three things well, and their domestic GDP continues to thrive the way that it is, then it'd be very hard for them to fall off the rails.
I mean, there's huge potential risks. Obviously, over the last 30 years, the government's done an incredible job of getting the country to where it is now, but they've got huge challenges ahead of them to make sure the next 30 years are as good for everybody.
Researchers at Harvard claim Vietnam will be one of the fastest growing economies in the coming decade, but only time will tell what's in store for the future of Vietnam.